HSBC fell 1.8% on Thursday. Standard Chartered dropped 2.8%, and Prudential collapsed 7.6%. Three of the FTSE 100's largest Asia-facing names moving in near lockstep on a day when the broader index closed marginally positive. The surface explanation, a South China Morning Post report that Beijing was tightening restrictions on mainland Chinese residents opening offshore accounts at Hong Kong banks, sounds procedural. It was not priced that way. What the institutional selling actually responded to was a regime question, not a headline. If Beijing restricts the inflow channel through which Chinese private wealth reaches these banks' Hong Kong books, the growth premise for each institution's Asia strategy is structurally compromised, not temporarily disrupted. Prudential's 7.6% decline was the most severe, and that asymmetry carries information. Prudential's entire forward earnings narrative rests on cross-border wealth management penetration into mainland Chinese clients routed through Hong Kong. A restriction on offshore account opening is not merely an operational inconvenience. It is a direct constraint on the client acquisition pipeline that Prudential's 2026 and 2027 consensus numbers embed. Institutional holders repriced that pipeline discount in a single session, interpreted from the price action alone, since no quantified capital flow data on Prudential's specific Chinese AUM was available in today's pool. Standard Chartered's smaller 2.8% decline relative to Prudential reflects a more diversified Asia book, but its Hong Kong retail banking franchise is still exposed to the same account opening channel. HSBC's 1.8% move, the shallowest of the three, reflects both the widest geographic diversification and the fact that HSBC already carries a structurally discounted multiple from prior China regulatory episodes. The gap between Prudential's 7.6% and HSBC's 1.8% is not a story of varying news sensitivity. It is a map of how differently these three institutions monetize mainland Chinese capital access through Hong Kong. What the initial session move leaves unresolved is whether Beijing's restriction applies uniformly across all Hong Kong banks or targets specific institution types. The SCMP report was not precise on scope, and that ambiguity means the market priced a worst-case structural reading today. If subsequent clarification narrows the restriction to new account categories rather than existing relationships, the 7.6% Prudential move becomes partially reversible, but only if the clarification arrives before the next session sees institutional position reduction compounding the first day's price signal.
The reason the China regulatory shock landed with such force on UK bank positioning today is that the capital available to absorb any dip was itself depleted by a simultaneous global repricing event. Broadcom fell nearly 15% overnight, erasing approximately $320 billion in market capitalization in a single session, a wipeout that the data shows ranks alongside the largest single-stock destructions in megacap history. Micron dropped 7%, ARM fell over 7%, and Crowdstrike declined 9%, pulling the Nasdaq down 1% while the Dow Jones gained 1.5%. The bifurcation was sharp. Defensives and dividend stocks attracted the capital rotating out of AI chip names, but that rotation was not rotating into UK financial names. The domestic institutional buyers who might normally use a single sector sell-off to build a position in discounted UK bank shares were instead managing an AI portfolio that had just moved against them simultaneously. The practical result was that the bid for HSBC, Standard Chartered, and Prudential on Thursday was thinner than the price move alone suggests, not because the news was misread, but because potential buyers were occupied elsewhere. Broadcom's earnings result was technically a beat. Its AI chip revenue doubled year over year, and quarterly earnings exceeded consensus. The stock fell 15% because its forward guidance for AI chip sales missed the elevated expectations that a 200% plus year-to-date run had embedded into positioning. Bank of America and UBS framed the guidance as supply-constrained conservatism rather than softening demand. Jefferies flagged gross margin pressure as the custom ASIC business scales. Baird introduced a more specific competitive concern. Broadcom's largest customer is shifting inferencing workloads to MediaTek, and that single line shifted the debate from conservative guidance on a strong base to structural competitor entry at the margin. Institutional holders who had sized into Broadcom on the premise of captive hyperscaler demand now face a different calculation. The capital that exited Broadcom in Thursday's session was priced out institutional selling, not panic retail liquidation. The stock's historical recovery pattern shows 80% of its 6% plus single-day drops were higher 1 month later, which means the exit was fast and professional, not terminal. That professional exit produced capital that was available and was not directed at UK financials. The connection to the HSBC chain is not thematic similarity, but structural. The same institutional desks that manage global equity portfolios hold both AI chip names and UK-listed financial names with Asia books. When a $320 billion single-session loss forces a portfolio-level rebalancing, the question for HSBC, Standard Chartered, and Prudential is not whether they are fundamentally cheap. It is whether institutional rebalancing demand clears before a second capital claim arrives.
That second capital claim has a date attached. SpaceX priced its IPO at $135 per share on Thursday, targeting a raise of at least $75 billion and a valuation approaching $1.8 trillion, with the public debut set for June 12th. Standard Chartered's Global Chief Investment Officer for Wealth Solutions stated directly that the sequential arrival of SpaceX, Anthropic, and OpenAI IPOs will create digestion challenges, and that the broadening out process doesn't happen in a totally smooth fashion. JPMorgan is broadcasting SpaceX's roadshow across 90 private bank offices and selected retail branches, and the company is reportedly allocating 30% of shares to retail investors, 3 times the typical IPO retail allocation. That 30% retail tranche on a $75 billion raise represents approximately $22.5 billion in demand being organized from the retail and private bank channel over the next 7 days. Index rule changes at the Russell 1000 and Nasdaq 100 mean passive funds will be required to buy SpaceX shares within 5 to 15 trading days of the June 12th debut, adding a further mechanical demand layer on top of the primary offering. The relevance to UK bank positioning is the timing competition. The institutional and private bank capital that would normally be available to re-enter HSBC, Standard Chartered, or Prudential at discounted levels following Thursday's China-driven sell-off will face an active and highly marketed competing claim between now and June 12th. Morningstar's fair value estimate for SpaceX is $780 billion, less than half the $1.8 trillion targeted valuation, which means that buyers paying $135 per share are pricing in a growth premium that requires SpaceX's satellite and AI revenue to grow according to the most optimistic scenarios available. Whether that valuation holds is a separate question. What matters for the UK bank re-entry window is that the marketing infrastructure being deployed, 23 underwriting banks, 90 JPMorgan offices, $22.5 billion in retail allocation, will successfully absorb available institutional capital before any meaningful recovery bid forms in the Asia book financial names. The monitoring variable is HSBC's price action during the 5 trading days before June 12th. If HSBC stabilizes above Thursday's close, while Standard Chartered and Prudential remain under selling pressure, the market is differentiating between the China restrictions scope for diversified versus concentrated Asia book institutions, which would confirm a structural repricing of the latter rather than a broad emerging market risk-off. If all 3 names continue lower together through June 12th, the SpaceX liquidity absorption thesis gains support, and the re-entry opportunity shifts to the post-IPO period, when index fund buying of SpaceX completes. The reading breaks if Beijing issues clarifying guidance that narrows the offshore account restriction to new account categories only, and the participant structure in HSBC, Standard Chartered, and Prudential normalizes within the same 5-day window, a development that would mean Thursday's institutional exit was a positioning overreaction rather than a structural repricing of the Asia capital access premium. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.